secret sauce is we live and breathe this every day. I come in the morning to pick on me, and I take a look at the American Banker or the ABA or both. And then I go right to Law 360, which is the trade publication that the lawyers use. And we live and breathe this every day. And we can talk about technology all day today. But at the end of the day, commercial lending is simple. You have to meet the customer on their terms. You have to understand their business.
Today we're speaking with Andrew Sagliocca, Chief Executive Officer and President of Esquire Bank. Our discussion digs into Esquire's business model of addressing an underserved market of litigation law practices, the unique value that Esquire provides, and how they've built out a position of not only enviable capabilities, but also how they've earned a level of trust and authenticity that could be impossible to copy. We also look at why serving lawyers and retail merchants makes a perfect combination for the $1.6 billion publicly traded bank. There's lots of insights and hard-earned lessons in this episode. Enjoy. Andrew, thank you for being with us today.
Thank you, Richard, for making time for us. We appreciate it.
So I think probably where we want to start is a little bit about your background in banking, in growth, and then we can kind of get into what's really unique and special about Esquire.
Excellent. I've been doing banking for about 37 years. I started out of college at KPMG in the financial services group. That was about 6 years. I left to go to one of my clients. The client was North Fork Bank. Everyone thinks of the North Carolina. No, it was the North Fork of Long Island. So I started at North Fork Bank. It was about $1.5 billion bank when I started there. In 14 years, we grew it to 60 billion, 30 billion. About half of it was acquisitions. We did about 14 acquisitions that I was there for every one of them. And in October 2006, we sold it to Capital One. I worked at Capital One for about half a year, and this opportunity at Esquire Bank came up. Obviously, I vetted it, and it turned out to be crazy enough to be a great opportunity. And here we are today as a public company.
And the best opportunities always are. So Esquire has a very unique and interesting business model, particularly one that has picked what seems like has been a very fruitful niche for you. Talk a little bit about the start, kind of coming into it at that point. What were you thinking, and kind of where did that go? Because obviously it's gone different places since then.
Yeah. Well, first of all, like I said, I thought the founders and the board were crazy for wanting to be in a litigation vertical, but it turned out to be obviously a great idea, and I thought it was unique and different. So the two niches we are in. One is a litigation vertical. About $500 billion a year settles through the banking system. Those are mass torts and class actions and single events, and Social Security, disability, and workers' comp type firms. That's, again, about $500 billion a year runs through the banking system on the depository side. And it was very underserved by the banking market because of banks' abilities to lend into that type of firm, which we can get into. And the other is about a $10 trillion market, which we affectionately call a payment vertical, which technically is a merchant acquiring bank. So today, there's about 120 banks that are merchant acquiring banks, processing the $10 trillion that we all swipe our credit and debit cards every day. And when we started, it was about 70 banks about 10 years ago. So those are the two national platforms that we focus on, and we're able to do nationwide, and we're able to do without branches.
So when you joined, was that was both of those in the portfolio of the bank?
No, the litigation vertical, if we want to call it that, was the focus of the bank. The focus was actually the depository side. But as a career banker, the ability to lend into plaintiff law firms is the key to accessing those low cost, very stable deposits, including operating and escrow accounts. And it was about 7 years later, we were looking for a fee-based, less balance sheet intensive vertical. We were well aware of the payment vertical, and I did not realize how few banks were in the merchant acquiring business. And like most things in life, we happened to run into a very seasoned veteran in this vertical, spent some time with that gentleman, and realized that this would be a great vertical to enter into. And we've done that the last 10 full years. So it's a nice diversity. One is balance sheet intensive, lending and deposits.
Mm-hmm.
The other is not balance sheet intensive, but generates quite a bit of very stable fee-based income.
So let's dig into the litigation side a little bit. These are what type of customer that you're gearing towards? I mean,
Sure.
Obviously law firms, but is there a particular size, or has that changed over time? Like, what's your ideal client look like there?
So I think the best place to start with the litigation vertical is that contingent fee plaintiff law firms have very long duration contingent inventories. So if you think about it, you are hurt in an auto accident. You are going to get a medical procedure and something goes wrong at the hospital, and you hire as a plaintiff or a consumer, you hire a law firm. 99, if not 100% of the time, it's a contingent fee law firm. And their success and revenue is based on successfully settling your case. Those contingent inventory of assets, those assets being hundreds, if not thousands or tens of thousands of claims, are A, contingent. They're not on the law firm's balance sheet, which makes them very difficult to value. And two, they are very long duration, averaging about 2 to 3 years, when most assets that are receivables or traditional inventories are typically 30 to 60 days for receivables or 120 days for traditional inventories and goods that are sold in the market. So it's very unique. It's very specialized. It's very different. And the duration of those contingent assets makes their cash flow for that law firm very erratic, which means that most bankers that don't live and breathe it every day and focus on it tend to shy away from lending into that type of industry, including me, the first 20 years of my career. And that's the opportunity. The opportunity is it's a very underserved, large, 50,000 plus plaintiff law firms, national platform that, because of the nature of escrow money, which are settlements or claimants' money, is a very, I hate to say it this way, but a very deposit-rich environment for a financial institution.
So your big, I was just going to say, your big value add here is you're providing them liquidity for kind of an underappreciated or a funky asset class that a lot of the rest of the banking industry has ignored.
Exactly. So if they have erratic cash flows month to month, quarter to quarter, a lot of times year to year, that's a hard vertical to lend into, and requires a deep understanding of that vertical. So we are filling the gaps in their cash flow with our lending products and services. which is needed by that community in a very meaningful way. And our ability to understand it and lend into it and help their erratic cash flows, which ultimately helps their claimants, gives us the right to say, well, we would like the depository side of your business too.
So how did the company, and maybe before you got there, how did you get into this business? What was the impetus or the insight or what? I mean, obviously, I'm guessing that's where the name came from originally.
Yeah. So
okay.
the founders of the bank were in what the industry calls litigation finance, non-bank litigation finance, for about a decade before they realized that a bank is probably the best solution to serving this industry. So that was the impetus, that was the genesis of it. And we started with that company's contacts, but obviously have grown that tremendously since founding it. And that was the interest when I left North Fork or Capital One at that time. The interest was not only the vertical and solving for a problem. That's a pretty big problem in the banking industry for this vertical, but their ability to attract law firms for 10 years prior meant there was a starting point, and we didn't have, even though we started the bank from scratch, we didn't have to start from zero contacts.
So I mean, other than the previous relationships and similar type business, what's really the hard part here? Because, plenty of banks could say, yeah, we serve a vertical and we just kind of show up and are willing to play in this market, maybe without a lot of the insight that's required to be successful at it. What for Esquire's the hard part? Is it underwriting? Is it, hey, we just have special insight and background into the legal practice in general? But what's the special part of what you've done?
The traditional, what got us here is the traditional difficult components were valuing law firms' contingent case inventory, setting those values by duration. So what types of cases do you have? Over what time span may they settle? Because there's no guarantee they settle in those time frames. And then valuing those cases and those related fees. That was one major hurdle. The second major hurdle is these law firms are all partnerships, and partnerships distribute all their profits. Why? Because at the end of the day, they're going to be taxed whether they're distributed or not. So now you're dealing with a commercial company that really doesn't have a traditional balance sheet or maintain traditional equity because it's all distributed primarily at the end of the year. The third was the erratic cash flows that came through the financials or the income statement. The fourth was getting the regulators comfortable with the fact that we were going to do a combination of traditional commercial lending coupled with non-traditional asset-based lending on long duration contingent assets. So the regulators were very good. The OCC was very good about understanding what we wanted to do, but slow and steady wins the race. So we had to go about it in a slow and steady manner the first 3 or 4 or 5 years. Another factor was that most contingent fee law firms are self-financed, and the ones that aren't were using non-bank finance funds. So there were a multitude of barriers of entry that we had to get through, that instead of taking a de novo bank and being profitable or break even in year 3 or 4, we weren't break even or profitable to year 6 or 7, almost double the time. And all those factors came into play. Today, probably as we fast forward today, it's not difficult, but the hurdle that we've been working on for the last 2 to 3 years is what we affectionately call thought leadership, which really means communicating to the law community that we understand their business model, their pain points, and that from a financial, accounting, banking, business standpoint, we actually can be helpful to their business model. And the tools we use are loans. And obviously, what we should be doing is processing and clearing their deposit transactions. But those are tools. Those are the tools we use for the means to the end. Really, if we can get the message across nationally to the legal community that to run a very good commercial business, you should always have lending facilities, whether you use them or not. And if you have those lending facilities, you should have them with an institution who understands your business model, appreciates your business model, and is willing to lean into light cash flow years rather than back away like traditional banks do.
So it seems like
one word, it's education, education, education.
It seems like a lot of that was created by you, as opposed to we're following an established route for how this comes out. Like, I'm assuming your risk controls are all pretty bespoke and unique. This isn't something that you just bought from a consultant or something to set up and do that.
No, most of our digital content, right? If I start on the front end and work to the back end, most of our digital content that we use for thought leadership, that is marketing materials, that where we don't sell products and services, it truly is thought leadership through our digital marketing cloud on Salesforce and our CRM on Salesforce, to our lending platform, which is nCino, to our front-end customer-facing platform, which is Q2, and I can go on. But all of those components, along with, or technology, along with our, if you want to call it, underwriting box, risk parameters, risk management, is all very unique and very specialized to the industries we serve. Although I named two, and so I named three: Salesforce, CRM, nCino, and Q2. So those are fairly standard banking products, but at the end of the day, we've done quite a bit of customization on them in-house to have them function at a very efficient level in the industry we serve.
And I mean, from the time you started, none of that stuff existed, or at least didn't exist in the way it is today. So there's this probably a continuous improvement or kind of reinventing what you're doing from a connect the business model to the digital aspects of what you're doing. Yeah. Is that a fair statement?
If I broke it down into 5-year buckets, just to use round numbers, 5 years was pain, losing money, getting people to understand the vertical we wanted to serve and how we could serve it effectively and efficiently in a safe and sound manner. 5 years, along with those first 5, was running around, shaking hands, kissing babies, doing it with bubble gum and Band-Aid. And the last 5 years has been deploying really robust, thoughtful technology platforms that we spend quite a bit of resources, time, money, people, customizing to fit our model. And, I think the benefit of that today, as you fast forward today, is I think we have, and I believe we have, a very good, well-recognized brand in the litigation market called Esquire Bank that is, quite different than 5 years ago, let alone 10 years ago.
And those first 5 years were, in a global recession and a catastrophe for the banking industry. So let me ask you, kind of putting it in.
I think painful is a nice word.
So let me ask you, thinking through like that period and what you went through and kind of blazing that trail, if you had to start over again to do something, either the same thing or something similar today, do you think you would have to kind of have that same path again, or would it be shorter? Is the environment different that's maybe more makes it easier or harder from some way?
Great question. I think, actually, I know if I had to do it again, the starting point would be quite a bit more capital. We started, believe it or not, with $17 million in capital. The number probably should have been, obviously, revisionist history. If I could do it over again, would have been 50 million, somewhere in that range. We have great people. This is not done by me. I am the CEO, but without great people around me, including the board and management and staff, none of this happens. I think with the right amount of capital, we could have attracted the talent we have today earlier. Whether it's day one or not is arguable, but I know we probably could have attracted the talent we have now earlier in the process. And I think coupling the capital with the talent, and then obviously the talent drives the resource, which is technology. Could we have shaved off several years, maybe as much as 5? Possibly. But that in a nutshell is the mistake. You still would have had to learn the vertical. I'll pick on me. I didn't know it. So you still would have had to learn the vertical and get to know it more in an expert manner than when I entered. You still would have had the hurdle that you had to get through of people understanding in the industry that, and when I say people, I mean law firms, that you can do this well. And I never like to blame the regulators. They're not the problem ever, as far as I'm concerned. They are part of the process. They're your business partner. They're the reason I have a charter. They're the reason I have FDIC insurance. So I know how this works. So you still would have had to make them comfortable over multiple, certainly more than one, probably more than 2, let's call it 3 exam cycles to get them comfortable that we are doing it well, that they understand it the way we need to understand it, and that they become comfortable and grounded in the fact that we can do this well. So I think those hurdles are still hurdles you had to overcome.
And probably time was a big factor there. I mean, obviously, in retrospect, you kind of know the answers to the test at the end of it, but it's interesting because let me ask you: did you actually ever hire anybody from your target market, like an attorney or paralegal or somebody in that space, to work at the bank?
We have our EVP who started the bank and actually was a key component of raising capital privately while I was still at North Fork before we sold it to Capital One, because obviously they raised the capital before they launched the bank in October '06, which is the same time that we sold. It's almost on top of each other when we sold North Fork. So one of our founding executive managers and head of business development nationally, Ari Kornhaber, is an attorney and did understand the industry and did understand how to lend in the industry, or certainly how to sell to law firms who wanted financing in the industry. And then we also brought on lawyers, one lawyer in the beginning, more than plural now, on the lending staff, because a key component of the underwriting is to review the inventory and sample it and pull cases and make sure that they're real and that the values are reasonable and that the timeframes for settlement are reasonable. So the answer in a long-winded way is yes, we started with some key people who had ties to the litigation industry and understood it. But then we surrounded that with traditional commercial bankers.
But there's certainly an element of, I mean, that's kind of part of your secret sauce. You're competitive advantage, that you're not just, oh, we're a bank for law firms, but legitimately you have this kind of legal practice, this understanding of litigation and all the factors inside your DNA for like how the bank operates.
And Rich, I might steal your line and give you credit for it. The way I say it is, we live and breathe this every day.
Yeah.
So it's not that hard. It really isn't. It's not that hard. You are doing commercial lending to plaintiff law firms or contingent fee law firms. It's a commercial loan. So, and the underwriting is not hard, because at the end of the day, you're always going to underwrite cash flow. That's a commercial loan. And if you have an understanding of asset-based lending, this is just non-traditional asset-based lending. And you're combining the two, traditional commercial cash flow, non-traditional asset-based lending. And the secret sauce is not necessarily the underwriting box or the credit policy. And yes, people are always a component of the secret sauce. But the secret sauce is we live and breathe this every day. I come in the morning to pick on me, and I take a look at the American Banker or the ABA or both. And then I go right to Law 360, which is the trade publication that the lawyers use. And we live and breathe this every day. And we can talk about technology all day today. But at the end of the day, commercial lending is simple. You have to meet the customer on their terms. You have to understand their business. You have to be a good listener. You have to provide solutions to their problems, which means it's a lot of personal, white glove, private banking service. It has to be. They're commercial entities.
But
so
that approach must be that approach must give you a level of real authenticity that translates into trust that is maybe intangible in how you look at it, but I imagine is heavily contributes to your competitive advantage, your ability to probably have much lower acquisition costs than maybe some competitors. So yeah, I think that's a really important part of this. That I certainly, I think we want to tease out for anybody who's looking at this and saying, I would like to do something similar, right? It's like, you cannot fake this. This has to be a legitimate part of who you are, as part of your culture, of what, just as you've very concretely demonstrated what your day-to-day looks like.
Yeah. We've been doing this 17 full years. We're on year 18. I still get on the phone with prospective customers, and typically when I'm on the phone with a customer, it's a problem and it's something they want to tell me we've done wrong, which I welcome because we can always improve. But prospective customers is probably a better example, which I still do quite often. And the ability to shut my mouth, listen to what they want to tell me about their business model, inevitably, either through leading questions or not, they're going to tell you what their pain points are. And our job from a banking and financial services perspective is to provide solutions to those pain points, or to be good consultants. You know, at times they'll have problems with people in their finance area and say, you know, we don't have a good CFO or a good controller. Well, guess what? Now that we've been doing that 17 years, we can recommend places to go and people to talk to find good people. So, you know, loans and deposits is great. Banking is great. I think what we try to be is a good advisor. And out of that comes trust. And out of that comes good banking services. Because at the end of the day, banking is all about trust anyway.
It's a great point. So let's shift a little bit and talk about the merchant services part of the business a little bit. And in particular, maybe on the compare and contrast side, and how this really helps you, as you began to explain at the beginning, from a business model standpoint.
Sure. So the crux of the merchant acquiring or payment processing platform was, like any good bank, I don't know of a bank out of 4,000 in the country that don't want a combination of a quality net interest margin and quality fee income. And we were no different. We were starting to see a very robust net interest margin, loans and deposits, and we were seeking and looking for a good quality fee income business without service charging the hell out of our high quality commercial customers who were leaving quite lucrative deposits with us. So just to touch on that, for every dollar we advance on our lines of credit in the legal industry, we get about $1.70 of low cost operating and escrow deposits. So that was a great model, but that's balance sheet intensive. And what we realized is that every business, especially post-COVID, every business is going to accept credit and debit cards. The merchant acquiring business exists. I did not do it in my previous life. As I told you, when we entered into it, there were only about 70 banks in the country doing it. And it couldn't be more different. It's like running two different banks, right down to the core. The core system for banking, traditional, is our Fiserv signature platform at the core house, the bottom, and our core banking system on the payment side is TSYS and First Data. They're not even the same cores. So we run three cores: Fiserv banking or signature, TSYS payment clearing processing, and First Data, which is now owned by Fiserv, payment. So the cores are different. It's completely different. And your credit card and debit card are commoditized, meaning you and I can get them from anybody as an issuing bank. Bank of America will give you a credit card. Citibank will give you a credit card. I'm sure you get hit with credit card opportunities constantly in the mail. But what most banks don't understand, including us when we got into it, was somebody needs to clear all those payments. And the only one who can clear payments between the consumer, the user of the card, and the merchant, the company that wants their revenue after you use your card, are banks, because we're the only ones that have a Fed account and can clear those payments. So that was kind of the impetus and the thought behind it. From there, you and I could talk hours on what makes it different, what makes it unique. So I'm going to pause there rather than meander.
Yeah, well, you kind of talked about like the obviously talent acquisition and finding the expertise from a vertical from a business model standpoint was really important. But I think that the main question I have is, what a different market you're serving, what a different type of customer. I imagine your go-to-market and how you sell is just as different as your technology stack is between the two. How did you go about, number one, is that a true assertion? And then number two, how did you go about building that out from what seems like was maybe a scratch starting point?
Yeah. So we ran into a gentleman through actually a commercial customer locally in the Long Island market by the name of Fred Horn. Fred has been in the merchant acquiring business for over 40 years now. Fred worked at Summit Bank in New Jersey before it was bought by Fleet, in the days where everything was paper and not electronic. Like I remember the credit card business where they used to swipe your card on a machine and give you a piece of paper. He built a merchant acquiring platform at Merritt Bank out of Utah. Shockingly, right here in Jericho. I didn't know he was 2 buildings over when I met him. I didn't know that till about 10 years later. And we met Fred, and, whatever happened between him and Merrick is their discussion. But we met Fred and made him an offer, and he joined us. And he was the crux, along with the bankers, myself and everybody else here, who were able to not only build out thesis and what we needed to build out, which is more of a treasury type function here. But he knew the market, and the market on the front end sales side is comprised of ISOs, or independent sales organizations, who do a great job selling merchant services to any and all businesses in the communities they operate in. And their front end sales agents are just that. They're agents, and they usually work for multiple ISOs and drive the business in. So the ISO goes out and originates the business, and we do the back office re-underwriting, because obviously they underwrite too, re-underwriting, compliance risk management, financial risk management, and then obviously we are clearing close to, on a run rate now, close to about $40 billion in debit and credit card payments a year.
So, I mean, you started doing this, you said this was around 2015 was when you entered this business?
2014, I think.
2014.
I think it was about
okay.
10 years ago.
Which kind of coincides with like kind of the beginning of the acceleration of fintech, particularly when it kind of came into the payment side. What is the impact been, or how do you see the market from a competitive standpoint? I mean, obviously you have players like Square out there that are, very laser focused on this market. How has that been as a more traditional institution, playing in this during this time of great upheaval?
Sure. I see both non-bank finance companies in the litigation space, technology providers in the litigation space, technology providers in the payment space. Let's put them all together and call them fintechs. I see all of those as business partners and not competitors. Why? Because banks typically suck at two things: owning real estate, meaning foreclosing on things that they lend against, and building technology. We're usually not that good at that, especially below the larger national or multinational banks. So to me, fintechs are business partners, non-bank finances are business partners, and we really go out and look for fintechs or banking as a service type relationships that fit our business model, rather than looking for a fintech to be a business model. I think a lot of bankers look to the fintech and BaaS market and are looking for a solution. We have our solution. We know what our verticals are. We know who we are. And we look for those fintechs that enhance and help our business model. For instance, Q2 is a fintech. Well, I use Q2 on the front end for customer-facing banking services, including on the lending side, for you to visualize and see what's going on with your loan. And we've customized that for our vertical quite extensively, and Q2 has been a great partner. Same with Encino. They're a fintech. We use them. We've highly customized that. We use certain risk management software on the merchant acquiring side that are fintechs. So I think they provide a great service. I think as they continue to evolve, the banks can continue to evolve. And I just view the world differently. I'm a simpleton. I know who we are. I know what we do well. I know we can scale the model. So let's look for fintechs that plug into us rather than us plugging into a fintech.
Well, Andrew, this has been fascinating. Really interesting to kind of get insight into your rather unique business model and the approach that you do it and what you've been able to build together here. I know there's more to talk about, particularly the process of going public, but I really appreciate your time. If anybody's really interested in learning more about Esquire or you or your background, where's the best place for them to go?
Uh, I mean, we do have on our website, we have obviously our earnings releases, our Qs, our investor decks. I think our investor deck is very informative. We try to break that down the way that we see the business and the way we run it. So I think that's informative. It's more than just financial information. It's a little preview of how we look at the business and how big the verticals are and how we run the business. We have 3 bankers who cover us. That their initial coverage did a pretty good job of explaining our story. And then, quite honestly, anybody interested could always reach out to myself or my COO, Eric Bader, who's been with me from the beginning. And we'd be happy to talk to him and explain what we do and how we do it.
And we'll put links to all of that in the show notes. Andrew, thanks again. Thank you very much for sharing with us today.
You know, Rich, I really appreciate your time. I really appreciate your interest. They were great questions. And listen, I enjoy sharing the story. I think it's unique and different. And, we come to work every day, and I think everybody here has fun and enjoys themselves because it is different. So we really appreciate your time and your interest.